Hey folks, welcome back to Was Capital and to this week's Market Analysis Explainer. This detail covers the week of June 29th to July 5th, 2026. This week's market is asking us to do something genuinely difficult, to sit with unresolved tension and not rush to resolve it. On the surface, this was about as clean a risk-on week as this series has recorded. The Dow hit a fresh all-time high, the VIX collapsed to 16.14, volatility compressed across the board. Bitcoin and gold both posted green weeks. Underneath that, a jobs report that missed consensus by more than half, Treasury yields that rose despite that miss, and a physical oil spread that swung from $3.05 to $8.79 in a single week. None of those things cancel each other out. They coexist, which is exactly the kind of week this report exists to unpack. Here's the roadmap. We'll start with the surface versus the structure, then the jobs miss and what the unemployment rate's actually telling us, then why yields rose into a soft print, then the whipsawing Iran spread and what it means when the signal stops behaving cleanly, and we'll close on the distribution update and portfolio. Let's get into it. The contrast this week's worth stating plainly before we try to explain it. The S&P rose 1.76% to $7,483. The Dow gained 1.97% to a record $52,905. The Nasdaq rose a more modest 0.72% to $29,320. The chipmaker softness from Report 29 still working itself out, just with less drama this time. The VIX fell 12.28% to 16.14, well below the 20 risk regime threshold we've been tracking. If you stopped reading there, you'd think the distribution had resolved cleanly to the upside. It hasn't quite resolved so cleanly though. The same week that produced those record highs also produced a jobs report that missed badly, a Treasury market that rose in yield despite that miss, and a Strait of Hormuz situation that both continued its recovery and issued a fresh warning shot. The Nasdaq's own reaction to Thursday's jobs data told part of the story. It was up around 4% at the time and fell 3.32% on the print, finishing the week barely above where it started. That's not a market that's made up its mind. That's a market digesting more than one signal at once. The headline macro event of the week was the June jobs report. It was soft. Payrolls came in at 57,000 against a consensus of 115,000, a miss of more than half. April and May were revised down a combined 74,000 on top of that. The downward surprise compounds. And yet the unemployment rate held flat at 4.2%. That combination is worth a moment. The unemployment rate's calculated as the number of people actively looking for work divided by the total labour force. Both halves of that fraction matter, but one gets considerably more attention than the other. If people stop looking for work entirely, maybe they've retired early, maybe they've given up the search, they exit the labour force and are no longer counted as unemployed even though they don't have a job. June's participation rate fell to 61.5%, its lowest level since March 2021. Put those numbers together and the 4.2% figure is doing less work than it appears to. Some of the stability is coming from fewer people participating, not from a stronger jobs market absorbing them. A falling unemployment rate driven by genuine hiring strength and a falling unemployment rate driven by workforce exits are very different distributional signals, even though they produce the same number at the end. That's the nuance the narrative chasers rarely acknowledge. This series does. The week's genuine curiosity was the bond market. Conventional logic says a soft jobs print pulls yields down. Weaker labour data means rate hike probability falls, bonds rally. And Thursday's data did do its job on the day. September hike probability dropped from around 64% to roughly 50%, and the 10-year dipped a couple of basis points. But across the full week, both the 2-year and the 10-year finished higher. The 2-year rose 1.00% to 4.137%. The 10-year rose 2.49% to 4.485%. The read here's that most of the week's yield move happened before Thursday. Monday through Wednesday, equity strength was broad and the Iran situation kept improving. Safe haven demand unwound. Yields moved on that. Thursday's jobs data then did its job on the day. It just wasn't large enough to erase what had already built up earlier in the week. Two forces, not one, and neither has fully won yet. Kevin Wash's comments at the ECB forum this week add important context. He said inflation expectations had eased over the past month and that there was no urgency to raise rates. That language is consistent with the look-through framing flagged after his first FOMC in Report 28. The policy tail risk that sat in this framework for 6 weeks is continuing to compress, and that's a meaningful shift. This is the focus area of the week, and it warrants the time. The OMO oil/Brent spread, the gap between the physical Oman benchmark and paper Brent, has now gone $7.96, then $3.05, then $8.79 across 3 consecutive reports. That's a complete round trip and some in 3 weeks. Oil fell 9.52% this week, far more than Brent or WTI. When physical oil moves that much more than paper, it tells you tanker operators dealing with real logistics and real corridor risk are repricing something. The question is what? There are 2 competing reads, and I want to be honest that both are available. The first's that physical operators are front-running fresh Hormuz risk. Iran issued a new shipping warning for the corridor this week, and formal diplomatic talks are paused through July 9th for morning ceremonies. If you're an operator moving physical cargo, you price that. The second's that last week's $3.05 reading was an overshoot, and the market's simply repricing back toward the broader Iran situation, which is improving in aggregate. Doha talks are making progress. Frozen assets have been partially released. Shipping recovery is real and cumulative. The distribution-relevant conclusion isn't to declare one of those the winner. It's that the spreads stopped behaving like a clean monotonic signal and started behaving like what it probably always was, a noisy read on a situation improving in aggregate but not in a straight line. 3 data points in 3 different directions across number 28, number 29 and number 30 is itself information. It tells us the market doesn't have high conviction on the corridor risk premium and is repricing it meaningfully on relatively modest news flow in either direction. Treat any single week's spread print with more humility than the last 2 reports may have implied. The trend remains toward normalization. The noise around it is high. No changes to the Valkyrie model portfolio this week, and both standing zero allocation calls continued to do exactly what they were designed to do. Gold bounced 1.49% to $4,187. That's still well below the $4,543 Valkyrie exit level, and the broader unwind from the conflict period safe haven bid remains intact. A bounce, not a reversal. Bitcoin bounced 5.00% to $62,445. That's a liquidity conditional move, falling near-term hike odds and a calmer VIX. Both provide a modest tailwind for the asset furthest out on the risk curve. But this comes after a confirmed bearish structural break and a new phase low of $57,735 the prior week. Short sellers covering into that liquidity pool is a reasonable mechanical explanation for the bounce. It doesn't approach any re-entry threshold in the model. The 4-year cycle framework and the zero allocation are both unchanged. The equity sleeve captured the broad rally cleanly across all 3 legs. Nothing near a rebalancing threshold. The 40% cash position stays. Cash, here is patient capital, not a forecast. The confirmation events ahead. Doha talks resuming after the pause, the FOMC minutes, the next CPI print, are the kind of thing the model waits for rather than anticipates. On the distribution, bear tail down to 11% from 13%, driven primarily by Warsh's ECB forum language compressing the policy tail further, base up to 55%, bull unchanged at 34%. Skew improves to approximately minus 0.05, almost neutral, the tightest reading since the conflict period began. The geopolitical tail didn't compress as cleanly, the Hormuz warning and the talks pause both keep a residual there. But the regime classification moves to risk-on, broadening, policy tail continuing to compress. 6 weeks ago that framing wasn't available to us. It is now. The lesson from this week's about holding 2 things at once. Record highs and a soft jobs report genuinely coexist this week. An improving Iran situation and a whipsawing spread coexist. A compressing policy tail and a yield curve that still finished the week higher coexist. The instinct to anchor to whichever narrative fits a pre-existing view is a liability in a market like this one. Distributional thinking, holding probabilities rather than conclusions, updating rather than confirming, is the actual edge. And that's the explainer for this week's report. You can read or listen to the full report on Substack, linked in the description. If it added clarity to your week, sharing it is the best way to support the work. Until next week, stay safe out there. Was.